Welcome again to today's lecture. Last time we stopped right in the middle of the discussion of the role of investment banks in IPOs. You probably well remember what an IPO is. It's an initial public offering. That is the very first time that a stock of a company is traded on a free market. And investment banks usually perform several tasks in advising companies to go public. What do? They provide advice. First of all, they're advisors because investment banks have usually done this a couple of times and have extensive expertise in this area. And they try to advise and consult these firms on questions regarding the initial public offering. They also act as market makers in the sense that they market the securities. For example, they simply buy up all the stocks that are being issued, and then they guarantee or they just guarantee a certain amount of stocks they want to sell. Now what they do is they usually guarantee that a certain amount and a certain number of shares are sold. And the investment bank will usually buy up the stocks, or at least a percentage of the stocks, and thereby stabilize the price of the newly issued stocks. So they market the securities. They also try to find buyers, institutional investors, which are then advised on buying up the newly issued stock, and they act as underwriters. The investment banks usually bear the responsibility of fair pricing. This is why we need to have some expertise in valuation, in company valuation, because the investment bank is required by the client to come up with a fair price for the new stock. And when a company goes public for the first time, buyers have relatively little information about the true value of the company. This is usually the risk, but also the opportunity. Take, for example, the IPO of Facebook. Back then, no one was really sure how Facebook would develop, how business would develop, and what the fair price of the Facebook stock should be. So this is an opportunity for investors, of course, and most investors hope that the stock price will skyrocket, but it's also the responsibility of the investment bank to find this fair price. For example, in the example of Facebook, the investment banks did not a pretty good job because they set the price way too high, and the first stock price on the market went down. One can analyze this whole set of this framework in which investment banks perform in an IPO from a research point of view. And there's been some extensive coverage and extensive research on the role of investment banks in IPOs, because usually this happens quite frequently. These deals are quite large. We're talking about multi-billion dollar deals and a multi-billion and even trillion-dollar industry. And the question now is, how should and how will the investment bank behave? They have an incentive to perform in the best interest of the client, but of course, because of unevenly distributed and asymmetric information, they can also try to not defraud, but they can use their informational advantage and try to make a quick buck of the client. One usually argues that investment banks have a self-interest and an interest due to self-preservation to act in the best interest of the client. Because if you do not act in the best interest of your client, you will do this once or twice, and afterwards you will lose clients and you will lose business, and some other investment bank will step in. But this is sometimes one reason why investment banks are highly criticized, because they sometimes do not appear to be acting in the best interest of their clients. When you have investment banks, there are two basic methods of selecting the accompanying investment banks, and the client will look for an investment bank either via a competitive offer or via a negotiated offer. Now, what is the first and which is the second? With a competitive offer, the issuing company can offer its securities to the highest bidding underwriter. So the client will select the investment bank that is simply offering the best price. Best price in the sense that it's the best price for the client. With a negotiated offer, the company works together with an underwriter, and companies usually do not negotiate with several underwriters, so negotiated deals usually suffer from a lack of competition, but issue costs in negotiated deals also higher than in competitive deals. Now the question is, why do you do a competitive? Why do you do a negotiated deal if you can also do a competitive offer? Usually because if you are too small, there will not be too many investment banks interested in doing your IPO. So it's, of course, a completely different question for Facebook, and all the investment banks were quite keen and eager to step up and take on this mandate and this new client. But if you're a small enterprise that is planning to go public, you will have a much harder time finding an investment bank that is offering a good price. Now, the price of the offer. Most difficult task for the syndicate of investment banks is, of course, to determine the correct price for the new stock. If it's too high, the IPO can be unsuccessful, which means that there will be stocks left and you are not able to sell all stocks that you are planning on selling. And if it's below the true market price, you will suffer an opportunity loss. Why an opportunity loss? Imagine the true price is 50 euros and you set the price at 40 euros. What will happen? And we have a fancy name for this phenomenon. This is what is referred to as underpricing. And what is underpricing?
Sold their stocks they owned as an underwriter for a higher price, and so make more profit.
The bank could have sold the stocks at a higher average price. In that scenario, the bank would have suffered losses. And if the banks had not engaged in a guaranteed deal and had not guaranteed the sale of the stocks, what would then happen? The company itself would have raised less equity. So it could have raised, say, 1 million or 1 billion euros in equity, and it ends up with only 800 million. So this is an opportunity loss because it is selling the stocks at price that is too low. Imagine I were the owner of Facebook and I would be offering 10 stocks at the price of €1. You would all buy stocks, of course, and then suddenly you would own a share of a multi-billion-dollar company, and you would have only paid $1 or €1. The result would be I could have raised a lot more equity. So this is underpricing. Share valuation. You can do valuation through comparables. Now, to value a company, financial analysts, this is what they do. This is what financial analysts do. They often check how much investors are willing to pay for one unit of an asset or for the profits of a group of similar companies. And what you can do is you can take the book market value ratios of comparable companies and compare these ratios to the one of the company that is supposed to be valuated. The book value is determined from historical balance sheet values, whereas the market value is determined from the stock market for these comparable companies in the peer group. You can also take the price earnings ratios, which is an indicator that compares the current share price with the share price again, a share price gain, not again. And in general, the book to market ratio tries to identify undervalued or overvalued securities, which is why the market to book or book to market ratio is usually a proxy for the company's and the market's impression of the company. It's either undervalued or overvalued. High price earnings ratio indicates that investors expect higher future revenue growth compared to companies with a lower price earnings ratio. Both ratios can differ considerably depending on the share, on the sector, on the industry, but even in the same sector. And on this next slide, you can see some figures, for example, for these companies in the S&P 500. You have Johnson & Johnson, PepsiCo, Campbell Soup, Walmart, ExxonMobil, Dow Chemical, Dell, Amazon, McDonald's, and General Electric. And you can see how these book-to-market values and price-earnings ratios differed in this particular year. I think it was 2010, 2011. And you can immediately see the vast differences, for example, between Amazon as a quickly growing tech company and General Electric, a company that has been around for almost 100 years. You can see a clear difference. Of course, the price-earnings ratio for Amazon's competitors, which are again tech companies and IT companies, the average price-earnings ratio for Amazon's competitors is also much higher than, for example, the competitors of General Electric. And ExxonMobil is even more extreme. Here you only have old and long existing companies in the oil industry. Okay. So this is what you can do at first. You can just look at the share prices of companies that have already traded stocks, and you can take the average ratios. You can try to compare these ratios with the one of the company that needs to be valued, and then you can try to come up with a fair share price, assuming that a new company with a new stock with this particular ratio, price earnings or book to market, should have a similar stock price. Okay. The second method to value a share is simply by using the discounted cash flow formula. What is a stock? What cash flows are associated with a stock? You earn dividends, and at some point in time you are able to sell off the stock. So if I go out and if I buy a stock, say of SAP, German tech company, I would expect SAP to pay me a dividend each year, €1, €1.50, €2 per share. And at the end of my investment horizon, I would sell off the share at the then current stock price. So the return should actually be dividend plus price in period 1 minus price in period 0 over P0. So I'm paying €100 for the share. The stock price appreciates by, say, €15. Now we have 115 minus 100. So the price has increased by €15. I also get, say, €5 in dividends. Then this is my return on the stock investment. Very simple. Because what I could also do is, if I am interested in today's price, I can simply rearrange this formula and argue that, well, I should make the same return as a comparable investment opportunity on the market. Now, let's take, for example, SAP. Assuming that we have a risk-free return of, say, 1%, which is even very high now, let's say we have a risk-free rate of 1%, we would perhaps assume and demand that a tech company offers a return of 3%. So the company, the stock, is of course risky. We have the risk that the stock defaults, and it should offer a higher return than the risk-free rate. So 3% is a reasonable expected return. Now, by rearranging this, we simply say, okay, this rate of return should be, I said 5%. Then we can just rearrange this whole set and this formula and try to calculate P0, which is the fair price today, which simply is dividend 1 plus P1 over 1 plus R, the return. Quite simple. The discount rate in this case could be an alternative investment asset. It could be the market capitalization rate, the cost of equity capital. It should not be the risk-free rate, of course, because the risk-free rate only applies to risk-free investments, and in this case we have a risky stock. But you can take a market return. You can also come up with some minimum return you would expect the stock to pay, and then you can calculate this price. So what determines next year's price? If you apply this formula in the same way, you get P1 equals dividend in the second year plus the price at the end of the second year, again over 1 plus return. And you can calculate the prices. Now, you probably know, and you've probably seen this in our basic class on finance and investment. You can try to calculate a stock price by adding up all the dividends the stock will pay out over its lifetime, and at the end, in 20, 30, 40, 50 years, you will also sell the stock. But you have to discount the price in, say, 50 years over a period of 50 years. And in that case, you know, this is a special case of a discounted cash flow, because the last payment, the price you're getting for selling the stock, this price will vanish due to discounting over 50 or even more periods. And you end up with a simple formula that you more or less only have to add all the dividend payments. And if you assume that the dividends are also constant, you probably know that this is quite simple, actually. You only have to actually, does one of you know how to calculate the current price of an infinite series of dividend payments? Now we've just said that the price P0 should equal dividend 1 plus dividend 2 plus dividend infinity goes over 1 plus R, 1 plus R squared, etc. Yeah?
Just dividend durch R.
The dividend, if it's constant, over R. Why? In German, it's called an ewige Rendite, ewige Rente. It's an infinite sum of dividend, of constant payouts. And it's quite simple, actually, because, and the reason is why, the reason for this is that actually this is simple mathematical series, and you can calculate the limit. I have to say k equals 1 to infinity, and you can simply calculate the limit of this series, and the limit is as simple as can be. It's just 1 over R times the dividend payment, which is constant in this case. Now here on the slide we have a slightly more simple idea. You have only 2 periods, and you can see you have dividend 1, dividend 2, and if you only look at 2 periods, of course you will take and you will consider the payout when selling the stock. But remember that if you have a longer investment horizon, you would actually neglect the price of the stock at the end, because it's just discounted over a very long time, and then it will vanish as well. Okay, and here you can see this is actually on this slide. You can see P0 equals this infinite series of dividend payments discounted with 1 plus R. And as you know, this is just, in German it's called ewige Rente. Internal set of cash flows, constant cash flows. Okay. So share value should be equal to the discounted stream of dividends per share, and this is more or less the discounted cash flow formula and approach to value a stock. You take the company, you try to forecast the future dividend payments, and then take all the dividend payments, come up with a sensible and reasonable rate of return, which is used for discounting, and then you calculate the current price of the stock by discounting all those future dividend payments. Okay. And this then is the present value of the expected future dividends. Okay. Same can be done with free cash flows. So that's the amount of cash that a firm can pay out to investors after paying for all investments necessary for growth. Take the present value of free cash flows, and again, you get the same result. Okay. This is a very simple description and discussion of how stocks and securities can be valued and how you can come up with a fair price for securities. Usually, you would have a whole set of lectures on asset pricing, on valuation, on also financial mathematics. This is an area where you have a lot of mathematicians trying to come up with new models to evaluate stocks and securities. It's almost always connected to arbitrage theory, because this idea I've just presented to you is, of course, the idea that the price is fair and the price fully reflects the true value of a share, the true value of the stock, and the price of the stock should only be as high as the future revenues and the discounted value of the future revenues of this company are. If not, the price is off. So an implicit assumption in using the discounted cash flow formula is, of course, arbitrage, free markets, and the validity of the two fundamental theorems in asset pricing. Okay, and then it's connected to financial mathematics. Last but not least, investment banks also heavily engage in sales and trading and structuring. This last main function consists of these three areas: sales, trading, and structuring. What is sales? Now, the sales desk of an investment bank tries to propose ideas for securities transactions to institutional investors. This is something you see also in many movies. Sometimes these are investment banks, sometimes these are stockbrokers. These are people, they used to sit at a desk with a telephone, and they phoned and called institutional investors and tried to sell them stocks. I have a good feeling about SAP. You should really go into SAP and buy up SAP stocks. Okay. If a client, if an institutional investor is willing to buy a stock, the investment bank will earn a fee, it will earn a commission fee, and the order will be forwarded to the trading desk. And the trading desk will then be a broker itself. They might have their own traders on the stock exchange, and then they will trade the stocks. Yeah, that's it. Trading desk, the second part, or simply referred to as the front office, executes the trading orders of its clients, and one part of the trading desk, the so-called proprietary trading, has no direct contact with clients and carries out securities transactions on behalf of and for the account of the bank itself. Now, this is the part where Usually investment banks take on a lot of risk on their own account, and they try to analyze markets. They see mispricings, they see that some stocks are overvalued and undervalued, and they try to exploit these differences in prices or these mispricings. They buy and sell stocks and securities, and they try to earn a profit by timing the market, by being smarter than all other market participants, and by using the fact that they are trading in wholesale anyway, because they have to buy and sell a lot of securities in their sales department anyway. And this is the part, proprietary trading, that is extremely risky. And if the investment bank does not have in place a proper risk management, a single deal can bankrupt an investment bank. And this is something that has happened before. Take Lehman Brothers, Lehman Brothers was bankrupted. Take the rogue trades at, for example, Société Générale during the financial crisis. There are numerous examples where traders in the investment bank did one or a bunch of trades that ended up causing billions of dollars in losses for an investment bank. They do not lose money by telling an institutional investor, you should buy SAP stocks. Well, if the client agrees to buying or selling some stocks, the investment bank will get its commission fee, but it will not have too much risk on its own account. Proprietary trading is the dangerous part. And this is the part, of course, where you can also learn a lot of money, where the bankers will earn a lot of money because they will get bonuses for good trades. And this is trading. And last but not least, structuring. Structuring financial products is something that is frequently done by investment banks, and this is what is also referred to as financial engineering. Do you have an idea what financial engineering is? Let me go back 2 or even 3 steps. I shortly mentioned the 2 fundamental theorems of asset pricing. The 2 fundamental theorems of asset pricing are concerned with the property of a market to be free of arbitrage. Does everyone know what free of arbitrage means? Who does not know what arbitrage is? Anyone? You know what arbitrage free means? No. Okay, then I have to explain. What is an arbitrage?
So when you can buy, for example, one good or a burger, for example, for cheap prices, or you can buy a stock in the one market for 15 and on the other for $20.
Usually it means the opportunity, the possibility to earn a risk-free profit by exploiting price differences. And it's equivalent for a good to have 2 prices. And your example, hamburger, is quite difficult because, you will probably have two qualities. But if you go, for example, in this perfume store and you find a perfume in its original packaging, and you see it for 30 euros here, and you see it for 25 euros on the internet. What you do, you buy it up for 25 euros, and you sell it on the internet for 30 euros. And then you buy up the perfume at the lower price, and you sell it at the higher price. And by doing so, what will happen? The prices will decrease and increase so that you will end up with one fair price. Exactly the same good should always have only one price. That is why the first fundamental theorem in asset pricing is also the law of one price. A good should only have one price in a market that functions. Okay, what is closely connected to arbitrage-free markets? Complete markets, which means in a very simple model. Take, for example, you have 3 periods, T1, T2, and T3. how can you write a cash flow? For example, X, Y, Z by a vector. And if the market is complete, this means that you can create any 3-element vector with any 3 numbers and any 3 cash payments in each and every one of these periods. If, for example, and then you might have seen this in the basic elementary class on finance. For example, if you have 3 securities, for example, 1, 0, 0, 0, 1, 0, and again 2, 0, 0. You can see that you cannot create this vector x, y, z via a linear combination of these 3 other securities. And this shows you that this market is not complete. You cannot generate any given cash flow with, for example, let's say I want 5, 5, 2. There's no linear combination of these 3 vectors that will span this vector and be a linear combination in that way, in such a way that this vector is a linear combination of the other 3. So the market is not complete. So arbitrage-free markets, complete markets are closely connected. I will not go into detail how they're connected, but usually, especially in these very simple examples, you need a complete market to show that it's free of arbitrage. Now the question is, how does financial engineering play into this? What is financial engineering? Imagine a capital market in which you have a certain number of stocks. And these stocks let's make it even simpler. Let's take some bonds. For example, you have a government bond that pays out 1, 1, and 101. And you have a second 0 bond that is 0, 0, and 102.5. Okay. Now, as an investor, I do not need the first or the second security, but I need a security, I need this cash flow. 2, 3, and 5. What could I do? I can try to construct this cash flow by buying or short selling the 2 bonds. Does it work? I have no idea. But what would the result be? I would need to pay a lot of transaction costs because I have to, let's assume I have to buy probably, well, it won't work anyway. I would need 2 of these. Then I have 2, 2, 202, and then I would make a short sale here, minus 1 point, and I would see, okay, first of all, I cannot construct this stream of cash flows. And the second problem is I would have to trade two bonds of the first kind and short sell the second bond 1.5 times. And I cannot construct this particular set of cash flows. Now, what is financial engineering?
Something that enables you to do that one more?
Financial engineering, is the process of creating a security that gives you exactly the cash flow, the set of cash flows you desire. And usually an investment bank, you will go to an investment bank and tell the investment bank, I need a cash flow of 2, 3, and 5. And the €5 paid here, they should only be paid out if Germany wins the next soccer championship, World Cup. Could be possible. And the investment bank would say, okay, you're crazy, but we do it anyway. And we will draw up a contract that pays out 2 next year, 3 in 2 years, and 5, okay, would probably then be the European Championship, yeah, if Germany wins another championship. And the question now is, what should be the price for this asset, for this security, for this contract? And this is financial engineering. The creation of a structured financial product, structured because you can see that you need to structure and you need to arrange other elementary and basis securities to come up with this particular stream of cash flows. And then the investment bank will need to calculate a fair price, and the investment bank will tell you, okay, we can offer you this contract, this set of cash flows, for a price of 25 euros. And then you say, okay, I need 1 million, so I will pay 25 million euros and I will get this financially engineered security, this asset. And this is what investment banks do quite a lot. They offer structured financial products, and usually it's an instrument consisting of one or more underlying securities and a derivative component, because you will not do it in such an easy way that you say, okay, I need 2 to 100 and 202, then you will simply buy 2 bonds. Needs to be a little bit more complicated, or it should have a derivative component in it. Just like I said, for example, the last payment is only paid out if Germany wins the soccer championship. A more realistic example is if you would say the 5, you will only get 5 if Daimler defaults. Question.
How does it work in reality? For me, it sounds like a huge risk hedging.
Well, that's the art behind it. The investment bank will do this on a large scale, and then you will see that they will buy a lot of securities, they will sell a lot of securities, they will be the counterparty in a lot of derivative deals, and then they will sum it all up and do a proper hedging and risk management. And then this is why they can offer it, because they engage in this kind of business in wholesale. It does not work if an investment bank would only do this occasionally. It only works if you do it regularly for a large set of customers. Then you can try to hedge all your risk, and of course you will price a certain commission into your price. Okay. Any other questions concerning financial engineering? And this is, this per se is not bad. I mean, investment banks are often and heavily criticized for being rogue traders, for ripping off customers. One has to see that customers usually go to an investment bank and they try to buy or sell a security that is currently not available on the market. They would not go to an investment bank and say, I need 102, such a simple cash flow stream. They could also buy up via a bond. They should be they are probably in need of a certain cash flow that cannot be constructed at the same price, only by accepting high transaction costs, and the investment bank can offer a better price, and usually this is not the risky part in the investment bank. It's more the proprietary trading. Yeah.
But I mean, isn't this part of the problem? Because those financial products are just so confusing to most people, so only investment bankers can understand them, and then they trust the investment bank that they have some nice working structured financial products like CDOs or so for them.
Yeah.
And then they trust them, they buy it, especially pension funds also, which need some return, and then in the end it all fails, and then it has a big negative impact.
Yeah, and nay. Yes and no. First comment, of course, is that this is usually only offered to institutional investors. So if you take Deutsche Bank, if you take Goldman Sachs, these financial products, these structured finance products, will only be offered to institutional professional partners and clients. Then again, one would have to say, if you don't know your business, if you are not able to see the fair pricing, and if you are not able to see the fair price of such a product, maybe you do not deserve to stay in the market. And lastly, it only becomes a problem when a large set of customers, a large set of clients, of other financial sector clients, are somehow in a way of herding behavior, or if they are all not able to see the dangers behind this. But from the standpoint of a free market, well, let them go bankrupt. If they are, no one forces a company to engage to buy a product the company is not able to price and not able to understand. If they buy such an asset and they have no clue of what the fair price should be, then they should not be buying structured finance products. And I mean, after the financial crisis, I would assume that even the last company in the financial sector has finally understood the dangers of some derivative constructs and some financial derivatives. And if they are still buying financial products they do not understand, well, then tough luck.
Yeah, but I mean, it all sounds pretty nice in theory and talking about the perfect market and so, but as it seems that in reality we don't have this perfect market, because looking at what happened during the financial crisis and building up some crazy structures from the 2000s.
There are two, yeah, I know what you're getting at. There are two mechanisms here at work that alleviate this problem to a certain bit. First of all, you always have financial regulation. So if this only becomes a problem when financial institutions engage in this and financial institutions buy up products they do not understand. For example, AIG didn't buy these structures, they offered them. But let's assume you have another investment bank or a smaller bank that buys structured financial products and then is not able to see the risks and goes bankrupt. This is only a problem in a free market if this is a financial institution and if it's systemically relevant. Then financial regulations can step in a little bit before that and just force this bank to either not engage in this type of product and this kind of business, or increase their capital ratio. Then in both scenarios, they are either prohibited from doing this business, or they have so much equity, they can go bankrupt. If it's not a financial company, if it's, for example, let's assume what happened during the financial crisis, if it's a municipality. For example, I know several major cities in my home area, Hagen, Dortmund, they bought structured financial products and they lost millions on that.
Or pension fund.
Also pension funds. Well, why are these actors, why are these economic agents, why are they engaging in this type of business? Why? No one forces them. Even if the city of Leipzig, if the city of Dortmund becomes too greedy, well, then they need to be taught a lesson. And that happened during the financial crisis. If, for example, this perfume store, if they thought it would be a good idea to engage in derivative trading, well, let them try. I mean, that is a nice profit for the banks. Then they can go bankrupt, and we wouldn't care 1 minute about them. They would go bankrupt, and someone else would step up. The company would be bankrupt. A competitor would buy up all the stores. There wouldn't probably be too many jobs lost at this. I mean, it's a good business. If they lose money on financial derivatives, well, the company will go bankrupt, and then someone else will take over.
I guess what you wanted to say is more when it goes to real life impact, when people are losing jobs, and then in this case, for example, if a big company, as you said, has to fail because it's in the wrong market or it's interacting in the wrong market, when the people in the end on the shop floor working or the blue collar.
Yes, of course. I mean, I have to admit that not in this class, but in the introduction to business, one student actually wrote in the evaluation, I should stop preaching the religion of neoliberal economy, which I assume I am not doing. But again, the problem you are describing does not come from this particular part of the financial system. It comes from the fact that some banks are systemically relevant. The bank can go bankrupt on its own and without having bought one single structured financial product. It can simply give out bad loans. Then it will go bankrupt. It will tear down the financial system, and this collapse of the financial system will have an effect on the real economy. This is the problem. The systemic relevance of banks and certain financial institutions. It's irrelevant why they go bankrupt. Yeah? I mean, during the financial crisis, it was structured finance, it was CDO trading, it was bad loans in the mortgage market. There are numerous reasons why banks can go bankrupt. The managers might just steal the money. Yeah? The same effect will take place. You will have banks will go bankrupt, the financial system will become unstable, and then you have an effect on the real economy. And a counter argument to what you just said with the banks, you were too young, but no one shed a tear about the workers at Lehman Brothers. Those were millionaire investment bankers that lost their job overnight. No one was crying for them. They got now nice payouts and they got other jobs a couple of years later, or they just thought, okay, I don't need to work anyway. No one was crying about the job losses at Lehman Brothers. Yeah? So this is a slightly complicated question, but I don't think it's fair to judge financial products per se. If they are meant to be traded in the B2B segment, if they are complex products meant for professional institutional investors, let them do it. A totally different question, should these products be marketed to private retail clients? No, definitely not. You can see this currently in the CFD market. I've talked a lot about CFDs and these other financial derivatives in all of my lectures, I think. This is totally different. And this can be seen right now because many brokers are trying to, they're targeting retail customers and they're trying to sell financial derivatives to retail customers. And I think it's the only choice and the best choice of the financial supervisory agency to prohibit these kind of trades if they have an unlimited loss potential. I mean, this is gambling, nothing else. And people do not understand these types of products. They just are lured into these trades by the promise of earning a year's wage in just one single trade. And this is gambling, with the difference that gambling is more regulated than this, up to this point. But now BaFin, the German Financial Supervisory Agency, has already stepped in, and they have for some time now, they have special power under paragraph, I think, 44b or 45b of the law that governs securities trading in Germany. There's a new provision in the German Wertpapierhandelsgesetz, the law for securities trading. And the BaFin, the German financial supervisory agency, was granted the special power to prohibit and to forbid certain products. And they've done so once with CFDs with unlimited loss potential. And you can read that on the internet, and I think this is different. Yeah.
Did they ban CFDs right away, or did it took some time for them to react?
Oh, it took them some time. I just wrote that up. That's why I remember it. I can show you. It's in German, but nevertheless, it's part of the. I think this is here. This is the old one. Where's the new one? I had that now. Where is it? No, chapter. Lecture. Aufsicht here. This is part of the Securities Trading and Electronic Trading lecture. I entered that. Where is it? Stimmrechtsanteil, Verdacht, Market Manipulation. Where is it? Talk. Not 44, 4b. Yeah, it is. Product intervention, it's called. The supervisory authority can act in the following way. They can prohibit or regulate the marketing of certain financial instruments. And this is new. This provision was inserted a couple of years ago. And as you can see, I have also one example. This is the Special General Executive Order according to paragraph 4b of the German law on securities trading concerning contracts for difference, CFDs. And this was done in May of last year, so it's not it's quite fresh, actually, quite new. And this is quite interesting. It's a letter to all market participants by the president of the Financial Supervisory Agency. This is why it's written like a letter. You can see, dear Madam or Sir, I hereby enact the following executive order. I'm ordering Beschränkung, the regulation of the marketing of financial difference contracts for differences, in the sense of this paragraph of the law, and it's has been enacted and it's in effect immediately. And there is also a very long part in this letter is concerned why they are prohibited. And the reason is because you can lose all of your money with a contract you do not understand as a retail customer. Okay, so this obviously makes quite sense.
But would you therefore say that if the authority doesn't forbid some financial products, it's the failure of the authority, not of the banks? Because we know that policy is way slower than the normal free private economy usually, and cannot react that quickly on every new product, which has to be examined and then looked at carefully.
Well, I would say that financial supervisors should have learned their lesson by now from the experience of the financial crisis. Meaning that they should be aware that, I mean, these are all experts in financial markets, although they are civil servants, of course. But they see market trends. They are in constant discussions with market participants, and they know what is going on in the markets. They might not see the dangers, but rest assured that financial supervisors in the post-financial crisis era are overly cautious. They are extremely cautious when it comes to financial stability by now, and they should see more than they did before the financial crisis. And the problem could rather be that they are a little bit overzealous. You can see that, for example, in insurance. Insurance companies are nowadays very heavily regulated and supervision is quite tough. Why? Because due to the AIG case, financial supervisors were surprised by the notion that insurance companies could also pose a threat to the financial sector. And as a result, financial supervisors and regulators have stepped up regulation and now keep insurance companies on a very short leash. The effect is that the sector is probably very safe and there is not a threat to financial stability at the moment, but insurance companies are hurting under this tough regulation. And then you can ask yourself, what do you want? 100% stability, 100% security, or do you want a market that leaves some opportunities, that has some opportunities also for investors? Other question: we wouldn't regulate perfume stores that heavily. If there's no threat and you do not see a threat, then you do not need to regulate.
Maybe a basic question: why would a company or a municipality need such a complex financial engineered product that outputs a cash flow maybe in 3 years, a high cash flow, and other years below?
Well, the human mind is, I guess, quite. It's similar for investors as for retail investors. Take CFDs. How are they marketed? Every time I open up YouTube and I either want to upload one of my recordings or if I just want to watch a late night show, I get at least 3 commercials for CFD tradings, for the main London broker that tries to sell me some CFDs. And what is their main argument? You can earn a lot of money. Back then, the municipalities and some other investors, they were just lured by the promise of a high return. The same happened with Kaupthing Bank, the bank from Iceland that was also active in Germany. They offered investors, they offered depositors something that resembled a bank account, a free and totally risk-free bank account, but they were paying 5-6% return on such a bank account. And later on, the clients found out, well, it's not a bank account, it's actually a financial derivative, and the money was lost. Now, it's quite simple. If, for example, you see that the ECB is charging negative interest rates, and someone offers you 5% return, you get suspicious. And if you're too greedy, you will accept this, and you will think that this is risk-free or that this is a very good investment. But if someone is offering you 5% in an interest rate frame and interest rate surrounding of even negative interest rates, well, 5% should be a very risky investment. And back then, the municipalities were, cities and counties are notoriously bankrupt. They are notoriously in need of revenues. And for some reasons, they believed banks that these investments were more or less risk-free and offered high returns. And this is something that always surprises me. This is something each generation, each century has to learn again from start. There is no such thing as a free lunch. You will not get 10% return without assuming risk. Quite simple.
Maybe for a last point, as I see it, so you would have let all the banks 2007, you would have let them all go bankrupt.
No, at that point it was too late.
So again, you would have said we would have had to regulate those instruments beforehand.
Exactly.
And then it was too late, and then
You cannot. No, in that situation, of course, you could not let all the banks go bankrupt, because at that point you could see that the financial stability was already in peril, and you needed to save the banks. But if you want to prevent such a situation to happen again, you need to regulate banks, you need to supervise banks, you need to supervise products, you need to prevent banks from being able to sell highly complex products to investors who are not, by definition, able to understand the mechanics behind these products. Retail customers, governments should prevent their municipalities and counties to buy such a thing. Pension funds should not be allowed to buy this. And there are, of course, at least in Germany, there are mechanisms in place that prevent pension funds to go into high-risk asset classes. You should prevent that. You should increase capital ratios. You could put other mechanisms in place to ensure that even if a bank goes bankrupt, it will not have a systemic impact. And if that is the case, of course, banks should go bankrupt. If you have a bank, take for example Deutsche Bank. Deutsche Bank is a prime example of a bank that now for almost 10 years has not been able to compete in a proper way with its competitors because they create their own problems. They have bad management. The management has made several bad decisions. They haven't got a clue if they want to be a retail bank, if they want to be an investment bank, or if they want to be both. Now, each and every month, they decide, okay, let's integrate Postbank. Now, let's sell off Postbank. Oh, okay, new management, let's keep Postbank. Now, this is a prime example of a bank that is too big to fail, but should have been broken up by the investors themselves a long time ago. And I'm still surprised that so many investors are still have some faith in the management. I would assume and I would predict that this management of Deutsche Bank will not be the management of Deutsche Bank at the end of 2018. They will be changed. There will be management changes along the way. But should they go bankrupt? If it weren't for the systemic relevance, of course, other banks are doing better. They're doing a better job, and this is still a free market.
What do you mean by broken up by investors? They should replace the management? Or?
No, but take for example Postbank and the retail section and the retail part. Now, if Deutsche Bank, or let's take any bank, if at some point they see that they are just too large and they have become too complex for management itself to have proper control over the company, well, then you should do what all companies do at that point. You sell off the parts that are not the main focus of your business strategy, and you keep the parts that you want to concentrate on. Bayer did that. BASF has done that. Yeah? You have several companies who have at some point in their lifetime decided, okay, take for example Bayer, they decided the chemical segment is not in the focus of our business strategy. We want to concentrate on pharmaceuticals. Let's sell it off and pay out the price to our investors. That's what you do. Now, Deutsche Bank, as I've said, has struggled for so many years to finally decide what they want to be. A retail bank, a universal bank, or investment bank. Right now, at this moment, the investment bank is not doing well. So they need the retail banking side. 5-6 years ago, they were thinking about becoming a full investment bank because the investment bank was generating high profits and the retail banking didn't a proper job. Now, this is never good. And if you have management problems, usually the market will solve this problem for you. Yeah? Okay. The problem is now it's obviously too big to fail. Yeah? Yeah. Any other questions? And enough with the investment bank bashing. And as I've said, one student in the Introduction to Business claimed that I am preaching the religion of neoliberal economy. I found that quite interesting. I mean, I'm quite happy to live in a free economy. Should usually guarantee you good products at a fair price. Some problems along the way, but nevertheless. Lecture 7 or slide set 7, bank accounting, financial accounting. Why do we need bank accounting? Why do we need special provisions on bank accounting?
Because it is so different to an industry company.
Yeah. Balance sheets of banks look completely different from the ones of industry companies. And why is that? The business is completely different. And as the business is completely different and accounting should reflect the peculiarities of the business, bank accounting is more or less completely different from the accounting standards for industry companies. So let's have a look at financial accounting standards for banks. We will concentrate on the German law here. This makes this part particularly difficult for me, because most of these concepts and even some words don't have an English equivalent, but you should get the basic idea. And some very short discussions on IFRS. Okay. Now, on the next couple of slides, there are a number of reasons why we need bank accounting, what is the function and the purpose of accounting and of balance sheets, and I will quickly step over this because I think this should be clear to everyone. Balance sheets and accounting and accounts are used to inform both internal and external stakeholders of the financial situation of the company. Investors want to know what is going on in the company, and of course management will also rely on the basic numbers that are generated by your accounting department to know what the current situation concerning earnings, leverage, equity is in the company. So in Germany we have the HGB, the German Commercial Code. HGB stands for Handelsgesetzbuch, which is the German word for German Commercial Code. It's a whole book, just like our civil code, the BGB, the Bürgerliches Gesetzbuch. The German Commercial Code is a large book with approximately, I would say, 350, maybe 400, I haven't counted them, paragraphs and sections in which all matters concerning the business and commercial trade, all matters of trade and of commerce are regulated. For example, it starts by telling who is a merchant. A merchant is someone who engages professionally in trading and buying or selling goods. Okay. Then, for example, a stock company, a public company is a merchant by definition. And if you are a merchant, Kaufmann, what does it mean? Special laws apply to you. For example, if I deliver some goods to, say, the perfume store, they have to check the quality of the goods immediately. They cannot say, oh, I haven't checked the delivery, I just realized this is not the quality I expected, I want my money back. Sorry, it's a merchant, it falls under the German Commercial Code, it has to check the quality at the same time. If I'm a small private customer, I have certain rights and I can reclaim my money within a certain time of period, because I'm not a professional merchant. So the German Commercial Code has a lot of provisions for many types of the day-to-day business of merchants, and it also includes all the provisions on accounting. Not just for banks, but for all companies and all industry sectors. IFRS, the same thing, International Financial Reporting Standards. The German accounting laws and IFRS are slightly different when it comes to their main purposes. Germans always claim that our commercial laws and the accounting rules are mainly meant to protect creditors. We're not interested in giving a fair and accurate picture of the company, but we want to give a fair and accurate picture of the company, but safety first. So creditor protection is the main purpose of our commercial laws, and especially the accounting laws. This explains some differences between German accounting laws and IFRS. Okay. And for banks, we have the German Commercial Code and some special laws that overrule the general accounting rules. So in the case of banks, again, the focus is on investors, and which investors in particular? Which main creditors?
Us.
Depositors, yes. Private clients, depositors. So deposit safety is, of course, one main purpose and one main aim and goal of bank accounting. And the problem is that banks, and we have a name for that. Banks are opaque, and the opaqueness of banks is a problem. This means that it's not easy to see what is going on in a bank. Now, one simple example. One only needs to have a look at the store, the perfume store, to know what they are doing. They're selling perfume. You can see they have a lot of customers. They have these products. Business seems to be good. So you immediately have a good impression of what business looks like in this perfume store. But in a bank, you do not know what types of loans they're giving out. You can see that they have some sorts of deposit accounts. Okay, you cannot count the clients. You do not get a full picture of the financial situation of a bank, and you do not know what the business looks like in a bank. This is one problem because, of course, you cannot look into all the different loan contracts. And this is, of course, also confidential information because the bank cannot simply announce, oh, we've just given out an emergency loan to company X or company Y, and they need the money to survive. So this information, of course, is confidential, and this means that in the end, banks are opaque. And this is why there is a special need for the information given in the balance sheet and the income statement to be accurate. So you need to trust these numbers. Okay. Then, of course, balance sheet and income statements, accounting figures have several purposes. You can calculate the profits. You can use these calculated profits to calculate the dividend payouts. Some accounting figures are used to pay out management if they have variable compensation, and so on and so on. But I'm pretty sure you know all about the purposes and functions of accounting figures and balance sheets and income statements. And investors want to know if the company is worth investing into. If you want to buy up stocks of Facebook, you should probably have a look at the balance sheet and the income statement. Okay. So this is the introduction, and then let's try to look at some of the main components of a balance sheet. Now, annual financial statements under the German Commercial Law Code are meant to contain information about the liquidity and risk situation of the banks. So the assets are structured by decreasing liquidity. This is the first difference between more or less a general balance sheet and the balance sheet of a bank. On the asset side, you have the assets sorted by decreasing liquidity and the liabilities by increasing maturity. You also have a differentiation of debtors between public authorities, banks, consumers, and it also provides a limited amount of information on the default risk of certain transactions because, for example, in the most basic scenario, you would have something like, for example, LLPs or NLPs, loan loss provisions and non-performing loans on your financial statements, because it might be that some of your loans are close to default or have already defaulted, and then you should include that information in your financial statement. And this is why you have bank loans, customer loans, but also loan loss provisions, non-performing loans, which just means that you know you need to depreciate some of your loans. That clear? Okay. Now, on the asset side of the balance sheet, there is a distinction between claims and securities. On the liability side, you have liabilities and securitized liabilities. Securities must be internally assigned to one of the following three categories for valuation purposes. Finanzinstrumente in German, financial instruments, trading portfolio, or liquidity reserve. The distinction is between German, it's called the Anlagebuch and Handelsbuch. So it's a difference whether you just keep the securities as an investment or if you want to trade on them. Investment banks will trade heavily on securities, but they do not keep them as long-term investments. And if you want to keep those securities as long-term investments, it's a different story than if you are juggling with securities for trading purposes. Okay. Net interest income and net commission income are shown separately in the income statement, and you will shortly see that income and interest income and non-interest income are the two main components of your income statement revenues. They are not, banks are not producing goods and selling of goods, but they are earning interest rates and they are earning commissions and fees. So you have interest income and non-interest income. Okay. So what's the legal basis for bank accounting under the German Commercial Code? The German financial statement consists of a balance sheet, an income statement, and notes, as well as a management report, sometimes also a risk report, and they have to be checked and audited by an auditor. In German, you can see this by the abbreviation WP, which stands for Wirtschaftsprüfer or public accountant. In the UK and in the US, CPA, not CPA, you have a certified public accountant, which is the same. If you want to become a certified public accountant or auditor in Germany, you need to have, I think, you need a master's degree from you need a master's degree in law or economics and a couple of years of working experience, or you can also do it without a master's degree, but then you need 10 years of working experience, and then you have to take an exam with the German Association of Certified Public Accountants, IDW, which is the Institute of German Public Accountants. It's a quite tough exam, and the ones who pass it earn a lot of money. And each financial statement needs to be audited by a certified public accountant. And for banks, you have special provisions that apply. For example, the paragraphs 340 to 340 O. This is not a zero, it's an O. Sometimes if you insert paragraphs later on, you have 340, 341, and if you insert it, you call it 340A. And this, you can see a lot of paragraphs were inserted here, so they had 340 A, B, C, D, and so on up until O. These are the accounting provisions, and you have the executive order on the accounting of credit and financial institutions, which is the executive order that lays the basic and the basis for the accounting of banks in Germany. And of course, you also have the basic German bank law, the KWG, Kreditwesengesetz. Those are the three main sources of law provisions that regulate bank accounting. And these special regulations only include provisions that deviate from those applicable to non-banks, which means you take general accounting laws and German generally accepted accounting principles. If not stated otherwise, these apply. And if you find a special provision in these three sources, then these special provisions come into play. Otherwise, you have to fall back to German GAAP. Okay. What is the structure of the balance sheet according to the German commercial code? It's stated in Form 1 of the executive order on the accounting of banks. A bank's balance sheet deviates slightly of that of non-banks. The order of balance sheet items is reversed, so asset side begins with cash and cash equivalents, liability side with outside capital, external capital. There is no division of assets into fixed and current assets. Financial assets are divided into numerous balance sheet items. Tangible assets, however, are combined into a single balance sheet position. And then you have some additional information on the static and dynamic liquidity. So here you have the relation between assets and liabilities, and also the degree of solvency and liquidity of certain positions on the assets or liabilities side. Okay. And this is how it looks like in German. Doesn't make too much sense to translate all of this, because you will never see a balance sheet or an income statement in this form under these accounting laws in English. It will always be in German. But you can see here it starts on the asset side with cash. You have bonds issued by governments and by public issuers. Then you have claims against other financial institutions, and you assume that it's better and it's easier to reclaim money from a credit institution or a financial institution than it is to reclaim one's money from, say, a retail customer. And the liability side, here you can see the liabilities with financial institutions. And second, the liabilities the bank has with respect to its customers. And here you immediately start with deposits. Those are the deposits. And as you can see, this is actually quite detailed. Here you can see this is also quite interesting. It's not as if the bank balance sheet is complicated in every way. There are some parts of the balance sheet that are, of course, quite easy and less detailed than for an industry company. Why? Because, for example, here, banks usually don't have too much intellectual property and immaterial assets on their balance sheets. This only happens, for example, if you have patents and if you have some other form of goodwill you've bought. This usually does not happen too often with banks. And also, these are, for example, real estate properties. Well, banks usually do not own too many houses. and too many properties. So these parts of the balance sheet can be less detailed than for industry companies, but of course all the financial parts and the parts that are concerned with financial instruments and liabilities, they are much more detailed and they give more information than for an industry company. And then you have some special positions, and I would say I will go into more detail next week. Do you have any questions? Okay, then thank you for your attention. Have a quick look over the next week on the balance sheet, and we'll discuss all of these positions in more detail next week. Thank you.